Those who believe the calendar can make money will eventually be buried by it. Listen to me, young man. On Wall Street, every December, a group of well-dressed people will jump out and tell you, the Santa Claus rally is here. Now is the best time to buy. They will pull out data from the past few decades, draw beautiful charts, and to try to prove that the probability of the stock market rising around Christmas is some high percentage. This is absolutely asinine. If you base your investments on the calendar, you might as well study astrology. At least astrology has a touch of romance to it, whereas these so-called seasonal trading strategies are purely statistical sloth and psychological greed. We must think in reverse. Invert, always invert. If the intrinsic value of stock automatically increased just because the Earth revolved to a specific angle around the sun, or because the calendar flipped to December, then every billionaire in the world should be a calendar printer. The so-called Christmas rally is essentially a mixture of two things. First, window dressing by institutional investors. Fund managers need to buy performing stocks at year-end, so their annual reports don't look too embarrassing. Second, mass psychological comfort. People tend to become blindly optimistic amidst the holiday atmosphere. But does this change the cash flow of the business? Does it change the mode of the business? Not at all. 1. Only fools rush into the dance floor at the peak of the party. This reminds me of the Nifty 50 era in the 1970s or the dot-com bubble in 2000. Back then, everyone acted like a drunken sailor. Not because it was Christmas, but because they thought the party would last forever. Looking at today's U.S. stock K-market, I smell the same thing. You view this year-end rise as a gift. I view it as a trap. Talent is the engine, and character is the steering wheel. But this kind of date-based speculation is like removing the engine and paddling along the ground with your feet, all while thinking you're driving a Ferrari. When everyone expects Santa Claus to drop gold coins down the chimney, what should a rational investor do? Sit on your ass and do nothing. In fact, you should check if your chimney is already clogged. Predicting the market by the calendar is a typical bias from association. Because Christmas is a happy day for receiving gifts, your brain automatically associates it with the stock market giving you money. This kind of thinking is lethal. 2. This consensus is the tumor we must excise. I remember an investment method called cigar, but investing, which Benjamin Graham, taught Warren. But even when picking up cigar butts, you have to check if the butt is wet. In today's market, people aren't picking up cigar butts, they're chasing fireworks. You ask me if the Christmas rally exists? At a short-term price fluctuation, perhaps it does. But as a basis for investment, it is rat poison. The best way to get what you want is to deserve what you want. Do you think you deserve wealth just by staring at a calendar and buying ticker symbols? No, you only deserve to be fleeced. True investment is when you understand the company's business in its next 10 years, not when you understand that today is December 25th. 3. The market pendulum and your discipline. Young man, in this noisy holiday season, the one piece of advice I give you is maintain extreme patience. The current market is full of noise. In this so-called Christmas rally, even garbage stocks will rise to heaven. You will see your neighbor, the guy who can't even read a balance sheet, bragging at Christmas dinner about how much money he made this week. At this moment, your envy will kick in. Envy is a stupid sin because it's the only sin from which you can never have any fun. What you need to do is watch them party, and then stare dead hard at the good cards in your hand. If you don't have good cards, hold on to your cash. Cash is not trash. When opportunity strikes, cash is oxygen. I don't deny that in the short term, the market is a voting machine, and Christmas sentiment casts more votes. But in the long run, it is a weighing machine. And Santa's gifts are often as light as a feather. Look at the S&P 500 now. Look at those tech giants placed on altars. Young man, what do you see? You see prosperity, the future of humanity, and AI changing the world. I see a severe form of mass psychosis. In physics, if you increase the load on a bridge to its limit, it will eventually collapse. But in financial markets, people seem to think the laws of gravity have been suspended. People are willing to pay $50, $80, or even $100 for a dollar of profit, believing there will be an even greater fool willing to pay $200. Invert, always invert. If a company's market cap is already larger than the GDP of many nations, can it sustain 30% growth every year? Math tells us this is impossible. But in Wall Street PPTs, anything is possible. It's just like the dot-com bubble I saw in the late 90s. Back then, any company with .com in its name could go public and rake in money, even if they didn't have cent of profit. Now, they've just replaced .com with AI and LLMs, large language models, for EBITDA, the lie after removing the bad stuff. You must be especially careful of management teams that mouth off about adjusted EBITDA. If you met a man on the street who told you, except for my gambling debts, mortgage, car loan, and mandatory alimony payments, I'm a millionaire, would you lend him money? Certainly not. Yet in the stock market, you're buying such companies. So-called EBITDA, earnings before interest, taxes, depreciation, and amortization. I call it bullshit earnings. What is depreciation? Depreciation is a real cost. If you're a dentist, don't you need to buy a new drill when the old one wears out? That is a real cash outflow. Many tech companies today hide massive costs through stock-based compensation, SBC, and then present you with a beautiful adjusted statement. This isn't innovation. This is the legalization of accounting fraud. Every time you hear someone use EBITDA to discuss valuation, you should clutch your wallet tight. 5. Only when the tide goes out do you discover who's been swimming naked. The reason the market remains high is that it's propped up by the greater fool theory. Combined with the addiction to cheap money over the last decade, the market is like a heroin addict. The moment the Fed tries to take away the needle, it starts convulsing violently. I had an experience a long time ago. Someone asked me what I thought of a very hot high-tech company at the time. I said, it's a turd. If you sprinkle sugar on it, it's still a turd. I don't deny technological progress. AI is indeed powerful, just as railroads, aviation, and electricity were in their day. But great technology does not equal a great investment. If you bought into airlines when the Indus trial was just starting, you would have lost your shirt. Why? Because competition was too fierce, capital requirements were too high, and the moats were too shallow. Today's tech stocks face similar problems: extremely high capital expenditures and extremely uncertain commercial prospects, yet they enjoy valuations that assume certainty. This is a typical Munger-esque tragedy, a group of extremely smart people in an extremely difficult field, killing each other in competition for meager returns. 6. All bubbles eventually revert to the mean. Remember one iron law. In the long run, stock returns can hardly exceed the returns of the underlying business. If you buy a company growing at 10% a year at a P/E ratio of 30, your returns over the next decade are destined to be mediocre or even negative. No matter how charismatic the CEO is, no matter how cool the product is, math is math. Looking at US stocks now, I see too many priced for perfection, or even priced beyond perfection, companies. At the slightest hint of trouble, or if earnings miss expectations by a hair, these skyscrapers built on sand will collapse instantly. This is the so-called Davis double play, in reverse, Davis double kill. When you buy too expensive, you aren't just paying for growth. You are paying for perfection. And in this world, aside from my wife Nancy, may she rest in peace, nothing is perfect. 7. So-called diversification is just protection for ignorance. Many young people say, Charlie, I buy index funds, I've diversified my risk. To a certain extent, that's true. But the current indices have been hijacked by a few giants. You think you're buying 500 companies, but your fate is tied to those 7 or 8. If you don't know what you're doing, diversification is good. But if you want to win in this cruel game, you must have the certainty to say, I dare to bet my life on this one hand. I'm sitting on a pile of cash right now, or Berkshire is, and people laugh at us for being old and missing the rally. But I tell you, while holding cash is painful during inflation, holding overvalued assets during a crash is fatal. I'm not afraid to wait. I once read Barron's for 50 years just to find a few opportunities truly worth striking at. When the opportunity comes, I will lunge like a crocodile. But in the current market, I don't see many plump antelopes. I only see a bunch of tourists taking selfies by the crocodile pool. Gold is a thermometer of fear, not an engine of wealth. Young man, you must understand a basic principle. Assets fall into two categories: productive assets and non-productive assets. If you own a hectare of fertile farmland, no matter what currency is used to price it, that land will produce corn or wheat every year. If you own a Coca-Cola factory, it will produce the sugar water people love to drink every year and spit out cash for you. These are productive assets. They're alive and they breathe like rabbits. But what about gold? If you buy an ounce of gold and lock it in a safe for 100 years, when your great-grandson opens the safe, it will still be just an ounce of gold. It won't give birth to little gold babies, nor will it pay you dividends. It just lies there quietly, mocking your stupidity. Warren Buffett used to have a brilliant analogy. If we piled all the gold in the world together, it would make a cube about 67 feet on each side. You could buy that cube, or with the same money, you could buy all the farmland in the United States, plus 10 ExxonMobils, and still have trillions of dollars left over as pocket money. Would you rather have a metal block that does nothing but shine, or would you rather own the food and energy industries of the entire United States? Only a madman would choose the metal block. But in the market, many people are such madmen. 1. Buying gold in chaos is lazy thinking. Some will retort, Charlie, but fiat currency is depreciating. The government is printing money. Gold is a safe haven asset. True, I hate inflation too. Inflation is a hidden tax on the people by politicians. But my method of fighting inflation is not to hide in a cave guarding gold bars, but to own companies with strong pricing power. If inflation comes, Hershey's can raise prices, and people still have to buy chocolate because they want to eat it. Costco can adjust membership fees, and people still have to go because things are cheaper there. The profitability of these companies will rise with the tide of inflation. That is true inflation hedging. Gold does have a specific use. If you were a Jewish family living in Vienna in 1939 and you needed to sow wealth into your clothes to flee for your life, then gold is useful. It is a survival tool, a last resort insurance. But if you live in a civilized society and buy gold simply because you fear stock price fluctuations, you're forfeiting the dividends of human progress. You are shorting human creativity. 2. Silver. Poor man's gold, rich man's heart rate monitor. As for silver, that is a playground for speculators. I don't deny silver has some industrial uses. Solar panels need it. Electronics need it. This makes it seem slightly more useful than gold. But as an investment, its volatility is laughable. If why? Oh, you want to experience a roller coaster? Go to Disneyland. Don't buy silver. Historically, the Hunt brothers tried to corner the silver market. The result? They lost everything. Trying to make money by predicting commodity prices is an extremely difficult task. It's like trying to predict when God will sneeze. Whether gold or silver, their value depends entirely on, as long as there is a next person willing to pay a higher price to take it off your hands. This greater fool game is not for me, nor is it for anyone who wants to get rich slowly through compound interest. 3. Invert always. If not gold and silver, what should you buy? Since I say gold and silver are hens that don't lay eggs, what should you buy? You should buy things that lay eggs. You need to find a business that doesn't require too much capital investment to sustain growth, has a product that is irreplaceable in people's minds, and has a management team that is honest and capable. If you find such a company, even if there is no Santa Claus rally for a while, even if the price of gold hits the floor, you don't need to worry. Because time is the friend of this type of company and the enemy of the mediocre. Just like See's candies. We've owned it for decades, haven't put much more money into it, but it sends us tons of checks every year. I can take these checks and buy Apple stock. That is the magic of compounding. For even when scavenging, do it where there is value. I don't touch Bitcoin. I've said it's rat poison. My attitude towards gold is slightly better. It might be a noble pet rock. You can admire it. You can make jewelry out of it for your spouse, which avoids domestic conflict. So that does have value, but don't treat it as the cornerstone of your wealth. If you're truly anxious, if you feel the end of the world is coming, then instead of buying gold, you're better off buying canned food and a shotgun. That works better in the apocalypse. But as long as you believe the sun will rise tomorrow and believe that humans will continue to improve their lives through trade and innovation, then owning equity in high-quality enterprises is forever the ultimate weapon to defeat inflation and chaos. Just avoid being stupid, and you beat 90% of people. People always try to be smarter, try to get full marks on exams, try to catch every limit up in the stock market. But I've spent my whole life doing one thing: avoiding stupidity. If I knew where I was going to die, I would never go there. This sounds like a joke, but it is a profound truth. In investing, what is the place where you die? It is high leverage, it is shorting, it is chasing hot trends you don't understand, it is frequent trading.